Afternoon, ladies and gentlemen. Welcome to the second podcast in the series. This one's entitled Making Sense of the Confusion. The year off started with a resounding negative outlook. On the 3rd of January 2023, the Wall Street Journal published a series of forecasts. Some 500 strategists, portfolio managers had cast their views and set their forecasts of 2023 and what was expected. And in general terms, the mood was very bearish. Forecasted a recession, Fed pivoting, inflation falling, earnings collapsing, and the S&P being at 3,300. The S&P is currently at a shade above 4,200. And everyone's wondering whether this recession that was much forecast is in fact going to take place. Before we get onto that topic, I'd like to just give you a quick performance update, and then we'll see how financial markets have integrated the macro view and how we have positioned global macro and how we are moving into the second half of the year in a slightly more defensive position. I'm very pleased to report that your fund continues to do well. The recent uptick in performance is very noticeable. We had been positioned very well for the year to date. Long duration stocks, stocks like Nvidia, Eli Lilly, Alphabet, Adobe, which we'll get onto in the closing portion of the presentation, have all performed particularly well. It's also a very auspicious moment for the fund. It has passed its 10th anniversary. The fund was launched on the 13th of May 2013. Our deep appreciation to all those that have journeyed with us. And we're very pleased to report a very commendable set of numbers over all measurement periods. The fund is in single digits over all the shorter term periods, and maintaining a comfortable first position over the longer term. Right, onto the current environment. The topic at hand is whether the US and the Fed in particular can land the plane softly. There are precedents in the past, 1970 to 71, the early 60s, 01 to 02. But as I'll point out to you, that this environment is very different. So what you're seeing on the charts in the dark areas, unemployment, nominal GDP, and real GDP. And the prognosis at the moment is for unemployment to rise slightly, for nominal GDP to stay relatively high, and real GDP to come in flat. It is very possible, but there are a couple of ever-changing winds blowing, and it's important to monitor those. One of those wind changes that have translated into a different set of expectations over the past 3 months is inflation. At the start of the year, the forward curve was looking for about a 2% inflation rate. The market has adjusted upwards to, I think, a more realistic picture where the current rate of inflation will drop down to around 4 next year and probably just under 3 by 2025. So that creates a higher structural level of inflation for the Fed to deal with. I think Fed Chairman Powell has been proven correct, and dare I say it, the market was a little overly optimistic. And so the market has had to adjust where it expects the Fed futures to go. What you're seeing on the chart is the actual sequence of rate hikes from the Fed. Our base case is the Fed stays flat for the next meeting and then maybe raises in increments of 25 basis points as it had done in the past. It is not unrealistic, we think, for a Fed's fund terminal rate to be about 5.5, and then for it to pause and wait for inflation to come down. So we are not in the school of thought that says the Fed has any urgency to pivot. If something breaks in the US economy, the Fed may well pivot, but for now we are taking a more sanguine view of the path of Fed fund futures. And the real issue around that is real interest rates. The Fed needs to re-establish a real Fed fund rate of about 1 to 1.5%. And so inflation would have to drop down to below 4% before the Fed thinks of pivoting. You can see the progression of growth and inflation expectations over the past 2 years. Growth is on the horizontal axis, inflation is on the vertical. And you can see how from January 2021, market moved up in growth expectations without discounting too much inflation, then moved into a higher inflation trajectory, then into a lower growth and lower inflation trajectory, and is now sitting with a higher growth but still low inflation trajectory on a 5-year forward-looking view. So the market is not overly discounting higher inflation at this point, and you'll see how that feeds into the bond market in a moment. One of the challenges with this point in the cycle is that in the past something is always broken. The Fed gets to a point where the higher interest rates have a knock-on effect to the liquidity environment. You can see on the right-hand panel, courtesy of a recent Alpine macro report, that the amount of borrowing by banks through the Fed discount window has now exceeded the 2008 global financial crisis. And that's a bit of a warning sign that liquidity shortages are starting to develop in the system, and equity market declines have in the past largely been precipitated or preceded by a change in the liquidity environment. And so whilst we did not concern ourselves unduly with the market decline last year, because of the absence of a decline in earnings, we're much more alive to the risks in the second half of this year as liquidity conditions start to tighten. The other thing that gives us some cause for concern is that if you look back at previous cycles where the Fed has pivoted or paused, and it's been a good pause, the macroeconomic environment was very different. Unemployment rates had risen. The unemployment rate in the US at the moment is still quite firm. You can see inflation had fallen quite a lot. Inflation is still high. The spreads on the 2 and the 10-year were positive. At the moment, we're quite negative, and so forth. So the Fed's dealing with a different set of variables. The US economy is still strong. The amount of money that was pumped in during COVID is still underpinning demand. Supply is coming back on stream from China. Europe is post its peak energy crisis. And so the need for the Fed to maintain higher interest rates is very real, no pun intended, because until it slows the US economy down, that inflation that we've pointed out a few graphs ago will remain quite structural. Another headwind that's starting to blow is lending standards. You can see on the chart that lending standards have tightened quite remarkably. We've seen the fall off in the regional banking index in the US. That is not a comfortable picture. It is secondary. The big banks are quite healthy, but adding to the liquidity crisis is that there are a lot of depositors that have very mindful of the 2008-09 global financial crisis, have pulled their deposits from banks and are putting them in money market funds that in turn deposit the money with the Fed. So we're starting to see the very early warning signs that liquidity conditions are tightening. With that comes the tightening in manufacturing, the tightening in the unemployment market, etc., and could create very much tighter conditions for the economy going into the second half of the year. One of the other developments that worry us is the short positions that have been taken up by hedge funds in the bond market. That's represented by the shaded area here. And you can see, compared to a number of years ago, the short positions have not been this great for a while. And that's suggestive to us that the market, certainly from a hedge fund point of view, are expecting rates to rise. Rising bond yields in recognition of higher structural inflation would not be good for the rating of equities. China has been, the market has hoped that China would pull the world out of any sort of recession, or at least lessen the extent of the US economic recession. We're not seeing evidence of that at this point. The Chinese recovery is quite mute. The restrictions had an impact on China's production, and also the tension between East and West hasn't been helpful. Another macro factor which we're paying very close attention to, which doesn't seem to get a lot of airtime, is the bond market in Japan, yield curve controlled by the Bank of Japan. The graph's a little bit busy, so I'll just take you through it. The shaded area is the area of yield curve control. The green line is the 10-year JGB, or Japanese government bond. And you can see the range in which the Bank of Japan was prepared to defend the yield curve. In very simple terms, if the yield were to pop above 0.1, the Bank of Japan would buy Japanese government bonds. If the yield were to fall below the lower bound, they would sell. More recently, the market broke the back of yield curve control, very similar to what Soros did on the pound in the 80s. And the market has been unrelenting in its pursuit of removing the policy of yield curve control. And this is quite significant from the point of view of how the Japanese economy has structurally changed. Inflation is running at about 3% in Japan. The 10-year treasury is at about 0.5. The two are not reconcilable. So if the Bank of Japan announces that yield curve control is going to be abolished, the market will likely take Japanese government bonds significantly higher. And that, together with the short position on the US long bond market, worries us as we move into the second half of this year. So how are financial markets responding? At the moment, quite predictably. We, courtesy of our access to macro bond, looked at a study where we looked at peak of inflation and what happened to the equity market prior to the peak and subsequent to the peak. And there's a very clear range in the shaded area, and you can see the dark line and how the dark line has followed the median pathway. These episodes or periods down here, which go back to 08, 1957, and other typical bear markets where you had the second phase of the bear market, which was a lot more severe, largely attributable to an earnings decline, which we are not seeing at this time. We're also of the view that the dollar is likely to go slightly stronger in the second half of the year, the dark line, and with that, upward revisions in earnings. So that side doesn't bother us. What does bother us a little bit is that we probably have enjoyed the maximum benefit for now of a lower volatility environment, and a yield curve that is probably about as stretched as it can be. So to refresh our memories, this is an asset allocation model we've built where we move from a growth phase into a contractionary phase, into a recessionary phase, into stimulus and back to growth. Why did we move this way when we should have continued to follow the path that way? The answer is exceedingly simple: central bank intervention. Bank of Japan supporting the yield curve, Bank of England dealing with the so-called Truss affair, Fed dealing with the regional banking crisis, Eurozone supporting its region because of the energy crisis. So we've had a mini quantitative easing period, which has pushed a lot of liquidity into financial markets. Volatility has dropped, and the yield curve has retained its inverted position. Our concern as we move into the second half of this year is we're going to start to move back up into a higher volatility environment as yields correct, and with that the potential to move into a setting where economies could move into the much forecast recession. Why is that important from a positioning perspective? This chart shows you how the different sectors perform within the different environments. We've been very well positioned, as I'll share with you in a moment, on information technology, consumer discretionary and services. But we think we're moving back into a world where the potential for downside does exist if we have that move in the bond yields that we have highlighted. So we're just a little bit more cautious than what we were and have been in the past 5 months. You can see the positioning of the portfolio has been almost perfectly positioned in a way. We've been very long technology stocks, long consumer discretionary, long staples, short energy, short financial, short healthcare, short utilities. These sectors have all underperformed. These sectors have all outperformed. The stocks on the right-hand side have produced exemplary returns. LVMH, Hermes, ASML, Amazon, Adobe starting to come back to life. Nvidia is up over 100% year to date, and so forth. So the positioning of the portfolio has been long duration in recognition of the expectation that bond yields would create easier financial conditions, but we think it's now time to take some of those profits and take risk off the table. If we have a look at some of the dynamics that are impacting on the market, there's a lot of talk about AI. We just rather look into the application of the technology, and this slide, which is extracted from a recent NVIDIA presentation, just shows you the scale of the impact of some of the technological changes in recent times. Apple is launching its new visual glasses tonight, and some 3 billion meetings would have been held online today. Quite an astounding statistics. The other impact of so-called AI is in vast range of industries. This is just an extract out of interest from the latest Eli Lilly set of financials, and you can see both the extent and the depth of the research and development that is taking place. Quite an impressive lineup. And then lastly, just to finish with maybe a snippet from the NVIDIA presentation where they announced that Foxconn will build automated vehicles in partnership with NVIDIA. Foxconn, of course, is one of the major producers of all the Apple products we enjoy. And so we'll leave you with the thought of maybe you're looking at a pre-release version of an Apple e-car that may or may not be announced in the near future. Let's see. Thank you very much for your time and attention. I hope that information has been helpful, and look forward to sharing some thoughts with you in a few weeks' time on our future podcast.